This is ACC Amit, and let's continue with a series on insights on IFRS. Till now, we have discussed the accounting standards IAS 1, IAS 2, IAS 7, IAS 8, IAS 10, IAS 12. Now, we'll move on to discuss the next standard, which is IAS 16 property, plant, and equipment. But along with it, I'll also discuss about the classification of assets, how the assets are classified or recorded on the basis of intent of the management, and how other accounting standards which are related to assets are linked with it. IAS 16 is a standard especially for property, plant, and equipment. Where property is land and building, plant and equipment is the machinery being used in the business. This is a standard especially for classifying or recording the assets which are being used into the business or which are being consumed into the business. All the assets are subject to depreciation. The only asset which is not subject to depreciation is land, since there is no defined basis of charging depreciation on it. Depreciation is a concept which is used by accounting to match the expenses over all the years which benefit from the use of that asset. If you have bought a machinery which is going to give us benefit for 5 years, we're going to record it as part of our asset. And since it is going to give us benefit for 5 years, we spread the cost over all the years which benefit from the use of that asset. How do we decide what will be the expenditure to be charged to P&L? It is decided on the basis of pattern of consumption of this asset. Mostly land and buildings, land is not depreciated, building is equally used over all the years for which it is going to give us benefit. So normally we use straight line basis for building. But machinery may not give us equal benefit over all the years. So we may think of charging reducing balance method or written down value method. We charge more depreciation in initial years, and as years pass by, the amount of depreciation reduces, which is for the reason that the repairs and expenditure relating to routine maintenance may increase in the later years. So to compensate the P&L of that year, we are charging more depreciation in initial years when the repairs and maintenance costs are low, and we charge less depreciation as years pass by and repairs and maintenance costs increase. So depending on the pattern of consumption, we decide the method of depreciation. And depreciation is an accounting estimate. If there's any change in method of depreciation, it is considered as change in accounting estimate, and we apply it prospectively. As far as capitalizing the costs are concerned, what costs can be included as part of the cost of the asset? So all the costs which are necessary to bring the asset to its present location condition for it to be ready for use are included. Which doesn't mean that we bought a machine and then we invited a celebrity and it resulted in a cost of additional 50 lakhs because we celebrated so much that the machine costed just 30 lakhs and we celebrated by spending another 50 lakhs that we bought a machine. Can we capitalize the cost as part of the cost of the asset? Machine was not at all responsible for this celebration. This is an advertisement expenditure, or this is your personal expenditure which cannot be attributed to purchasing of machine. Machine purchase was simply an event. You cannot add up all the cost to the event of buying the machine and add up all the cost to the machine and then expect the machine to give us all the return. That's not possible. Any such administrative expense, any such storage expense, any such expense which is not necessary for bringing the asset to its present location condition for it to be ready for use cannot be added to the cost of the asset. But if it is necessary expenditure like installation, anything which is necessary is of importance and can be added. Within this cost, also, if there are any annual cost like registration tax or insurance being paid for buying a motor vehicle, if you are paying this cost annually, there's no point capitalizing it because every year we'll bear this cost. So if we add up the cost of insurance in the first year and we spread this cost over a period of 5 years, next year again we'll have to bear annual insurance cost. It will not make any sense to capitalize the cost and then spread it over all the years and also bear the insurance cost separately every year. So any such cost which is annual in nature, there's no point capitalizing it because anyway we'll be bearing it annually. The concept of depreciation is simply that we spend money once, but this expenditure which we've incurred, if we capitalize it, it is known as capital expenditure. And if this expenditure is going to give us benefit for a longer period of time, it makes sense to spread this cost over all the years which benefit from the use of that asset. And by charging this to all the years which benefit from the use of this asset, we are matching the expenditure with the income earned because we use that asset in that period, right? Once we have recognized the cost of an asset, we need to decide the subsequent expenditure. For recognition of subsequent expenditure, we have two methods. One is cost model and one is revaluation model. If it is cost model, we recognize it at historical cost less any depreciation which we have charged till date. It's like a responsibility of recovering the value of an asset. That we recover the value of an asset through use, and if we have charged any depreciation, which means that we have recovered this value and we do not need to worry about that expenditure anymore because we have recovered by use over all the years which have benefited. In future, if we sell this asset, we always consider what we spent on this asset, how much we have recovered in the form of charging depreciation to P&L, which is kind of a recovery from the use of that asset. And if someone is ready to pay us some amount, we add that amount being paid by someone for buying that asset to the recovery, and then we compare it with what we spent initially when we bought this machine or we bought this land or building or any such asset. It will give us profit or loss on disposal, which is a non-cash item presented as part of P&L. The manner of depreciation is also decided on the basis of presentation. Like if you wish to show the depreciation accumulated in an account, we create a provision for depreciation in the form of accumulated depreciation, which keep a track of how much depreciation we have charged till date. But if you wish to charge the asset directly, you can do it by charging the asset directly. In that case, we'll not be able to track the depreciation because the asset which we bought suffered depreciation and we have hit that account directly with the charge of depreciation. So the value presented on the face of the balance sheet is net book value, which is after charging depreciation. We'll not be able to track the depreciation charged on it. So in order to track the depreciation, it makes sense to create an account known as accumulated depreciation, which gives us an insight on how much has been recovered till date, how much money we spent initially, and in case we plan to move on to revaluation model. Now, this decision of moving on to revaluation model is choosing an accounting policy which cannot be reversed. We move on from cost model to revaluation model. When we move on to revaluation model, it may result in some gain or loss. If on first time revaluation we get a gain, upward movement, that upward movement means we'll create a revaluation surplus. The creation of a revaluation surplus is an unrealized gain because there is no benefit which is provided in the form of cash when we revalue an asset. It's not a realized gain, it's simply an increase in the value of an asset. That increase in value of an asset does not increase any cash as part of the balance sheet. It's simply an increase in the value of an asset, which indicates that we are going to receive more of economic benefits in future. More of economic benefits in future for the time being will be reported in the form of an unrealized gain as part of other comprehensive income known as revaluation surplus. In future, if there is any fall in the value of an asset, we'll make sure that we'll first consume any reserve we have, and then any extra loss if we suffer by chance in future will be charged to P&L. If on first time revaluation our asset suffered a loss, a downward movement, then we have no choice other than charging it to P&L. And in future, if we get a gain, we'll first ensure to reverse the charge to P&L, and any excess we can create a reserve. I sometimes say that it's like borrowing the money from your friend. If you get a gain, do you call all your friends and tell them that I have money, I earned it yesterday, let's distribute it? You'll simply pocket it or save it. Suppose you have 70,000 in your pocket and in future you suffer a loss of 90,000. Will you call all your friends to demand 90,000 loss? Even or in spite of the fact that you know that you have 70,000 in your own pocket, there is a reserve, revaluation reserve, which is linked to this asset. You created a reserve earlier, 70,000 is in your pocket, but in future you suffered a loss of 90,000. In spite of it, you're demanding it from your friends. Does it make sense? What makes sense? First, use your own pocket, use 70,000 from your pocket, and if any excess support you need, you can demand it from your friend, 20,000 from your friends. In future, suppose there was a gain of 45,000. Will you pocket it directly? that I have got a gain? Or will you remember your friends who supported you with 20,000? It will be fairer in approach if you first give back to your friends. That if there was any charge to P&L, first reverse the charge to P&L of 20,000. Any excess, you can create a reserve. If there is a gain of 45,000, first reverse the charge to P&L of 20,000. Any excess, 25,000, you can create revaluation surplus. The show goes on till the asset is with us. On disposal or derecognition of this asset, any revaluation surplus relating to it is transferred to retained earnings. There is a choice before it as well, that if every year you wish to transfer excess depreciation from revaluation surplus to retained earnings, you have a choice. Because of revaluation, what happens? The depreciation you were charging till date differs from the depreciation you begin to charge when you have revalued an asset. This results in an excess depreciation being charged to P&L. The P&L gets an excess depreciation, the retained earnings are short of the exact profit which they were enjoying till date simply because of revaluation. So to reduce this accounting mismatch, there is a choice given that you can transfer excess depreciation from revaluation surplus to retained earnings. If you're contented and satisfied, you also have a choice that wait and watch, and when this asset is disposed of or when this asset is de-recognized, any revaluation surplus relating to it will anyway be transferred from revaluation surplus to retained earnings. You can wait and watch. But if you want an immediate action, you can transfer excess depreciation every year from revaluation surplus to retained earnings. That's how the revaluation model works. Apart from that, you also come across decommissioning, dismantling, and restoration costs, which has a link with provision. If you buy an asset which also has a present obligation as a result of buying this asset, that you'll have to incur some expenditure on dismantling, decommissioning, and restoration. The cost of restoration, dismantling, decommissioning, which you expect to incur in future, we discount it to present value, add it to the cost of the asset today because that's part of the decision today. Though you don't make any payments today, you make payments only for the cash price of that asset, but there is an expected cost to be incurred when you restore, decommission, or dismantle it at the end of the useful life of this asset. You do not ignore this restoration dismantling cost and you calculate the estimated present value of this expenditure you're going to incur in future. You add it as part of the cost of the asset today and you create a corresponding liability today in the form of a provision today. So it has a link with IAS 37 provisions, contingent liabilities, and contingent assets. But this concept is of IAS 16 property, plant, and equipment, that we need to add decommissioning, restoration, and dismantling cost as part of the cost of the asset today. Apart from that, you'll also come across major inspection and overall cost for large assets. So there is a concept of component accounting, that if there are large assets, we need to divide all the large assets into various components. Each component may have a different useful life. We'll charge depreciation on the basis of different useful lives. The useful life is not necessarily on the basis of number of years as well. It can be depreciated on the basis of number of units of production. It can be based on the number of hours a machine can run. So there could be different bases of charging depreciation, and every component can have a different useful life and different value assigned to it, even though it is part of a large machine. So a large machine can be divided into various components. Among these components, if any component is replaced, that is treated as enhancement of an asset. We replace the existing asset and we add the cost of the new asset as part of the total property, plant, and equipment block and de-recognize the existing part. That is known as replacement of a part. There is major inspection and overhaul required for some large machines or large assets. That major inspection and overhaul is also treated like a replacement part. Though it is not physically visible, but when we purchase a large asset, we assign some value to major inspection and overhaul, which will get depreciated till the next overhaul. It is treated equivalent like a replacement part. And after every 4 years, we need to do major inspection and overhaul, and which will cost money to us. We assign a value out of the total money invested in purchasing an asset to major inspection and overhaul as well, and it gets depreciated over a period of time. On the next major inspection and overhaul, whatever money is spent, we capitalize it and we depreciate it till the next overhaul or major inspection is required. So it's treated like a replacement part. This is how we deal with IAS 16 property, plant, and equipment. When I said that intent of the management decides what this asset is for, If we buy an asset for consumption into the business, it is IAS 16 property, plant and equipment. If you buy an asset for sale in the ordinary course of business, it is IAS 2 inventories. If you buy land and building for capital appreciation and for renting it out to others, it will be classified as investment property under the head IAS 40 investment property. If you're dealing with biological assets, they'll be forming part of IAS 41 agriculture. Biological assets are living animals and plants. If you intend to sell any asset within 1 year from the date of classification, it can no more be part of IAS 16 or IAS 40. It has to be classified as non-current assets held for sale. Reclassification from non-current asset category to current asset category. If it is an intangible asset, it is supposed to be dealt with IAS 30 intangible assets. And if we need to test for impairment, there is a standard known as IAS 36 impairment of assets for dealing with impairment. And there are some standards in the supporting rule, like IAS 20 government grants, that if you bought an asset and if you received grant for buying these assets or for meeting those conditions, how to deal with them. Government grants helps us in dealing with the value of an asset, either directly deducting the value or recording a deferred income approach. We'll discuss it shortly. IAS 23 is the supporting rule standard which helps us in knowing can we capitalize interest cost as part of the cost of the asset. IAS 36 impairment of assets tests for impairment for assets recognized on cost model. So these assets which are reported on the balance sheet also have a supporting standard which will help in knowing whether interest will be capitalized, how government grant will be dealt with, how impairment is to be dealt with. They do not get presented directly on the balance sheet. Like impairment has no direct presentation on the balance sheet except an impairment loss in P&L and deducting the value of an asset. Then there is a standard related party disclosures which discloses about the related party relationships of the entity. The next standard after IAS 16 is IAS 19 employee benefits. Employee benefits talks about short-term benefits, other long-term benefits, termination benefits, and post-employment benefits. Short-term benefits, other long-term benefits, and termination benefits are presented as part of P&L in the year in which they are reported. So whatever is the cost for the year, we charge it immediately to P&L. In other long-term benefits, we need the help of an actuary, and in post-employment benefits, we need the help of an actuary. Other long-term benefits are like long service awards. The employee remains with the firm. Post-employment benefits, the employee leaves the firm. They get benefited when they leave the firm in the form of a gratuity. If they spend 5 years with the firm, provident fund. When they leave the firm, they get benefited from provident fund. The pension fund, when they leave the firm, they get benefited from it. The post-employment benefits are divided into two parts. One is defined contribution plans and one is defined benefit plans. Defined contribution plans, we can say provident fund is kind of a defined contribution plan. Whatever money is deposited in the provident fund is on the basis of percentage of the basic salary. It's defined contribution into the fund of the employee. The employer will not make up for any loss. Howsoever the fund behaves or fares is the risk or benefit of the employee now. The liability of the firm is simply to contribute to the fund on the basis of the percentage assigned. Whatever is being deposited by the employee, similar amount is being deposited by the employer. That's how it functions. And howsoever it fares, whatever interest it gets accumulated in that fund, employee will get it once they leave the firm. The second type of benefit is defined benefit plans. It's mainly like gratuity, someone has spent 5 years with the firm, pension funds. Now, on the basis of the mortality rate, geography, the life expectancy in the country, considering all other factors, we take the help of an actuary who, looking at the various assumptions, gives us a value that we need to be prepared for making payments in the form of defined benefit plan liabilities. Now, the actuary will tell us how much money we need to assign to a fund to be able to meet these liabilities. Now, we need the help of an actuary every year to fair value these planned liabilities and fair value these planned assets. After this is set up, next year We'll record interest income on our plan asset, which will record as part of P&L. We'll record interest expense on our plan liability. If employee has completed 1 year with the firm, we charge the current service cost as part of the P&L and we add it to the plan liability. If we have changed the plan, any past service cost may result in additional cost. That additional cost is also charged in the current year and added to plan liability. So we are successful in recording interest income and interest expense on our plan assets and plan liabilities. We could account for it. If any employee leaves the firm, if we have paid out any benefit to that employee, our plan asset reduces and our plan liability reduces with a similar equal amount because we use the funds to pay off those liabilities. So we can account for it as well. If there is any benefit paid out, it reduces the planned assets, it reduces the planned liabilities. If during the year we pay any contribution to the fund, that contribution to the fund increases our planned assets and cash reduces from the business. When the year ends, we again seek the value from the actuary. They will give us the fair value planned assets and fair value planned liabilities at the end of the year again. But we notice that what we accounted and what the actuary has given, there is a difference. It did not match exactly. It can never match exactly because the fair value plan assets and fair value plan liabilities is given on the basis of assumptions used by the actuary. And we did accounting on the basis of accrual basis, charged interest income, interest expense, charged current service cost, past service cost, accounted for contribution to the fund, accounted for any benefits paid out. Whatever was in our control, we did. Whatever we could not control is known as unrecognized actuarial gain or loss. Not do anything about it. The management has no control over it. If management has no control over it, then we cannot do anything. So it should be part of P&L or OCI. It should form part of other comprehensive income is the reason the unrecognized actuarial gain or loss on defined benefit plans forms part of other comprehensive income. The same calculations can be done for other long-term benefits as well. Long service awards. The benefit is defined. How the benefit is defined? Like in a defined contribution plan, the provident fund, the benefit is contributed. It's a defined contribution plan. The benefit contributed to the plan is fixed. But here the benefit is variable. It's a defined benefit plan, like 1% of last drawn salary for each year of completed service. Now it is based on probability, 1% of last drawn salary for each year of completed service. Someone is working in 2023, they're going to retire in 2050. And whatever will be their salary in 2050, counting from the year of joining till the date of retirement, and at the date of retirement, what is their last drawn salary? 1% of that last drawn salary for each year of completed service. We use projected unit credit method. We project the salary in year 2050. We assign the same 1% of last drawn salary for all the years which we expect the employee to work with the firm. And that becomes the total liability of the firm. Now, some payment we need to make in 2024. One payment we'll make in 2025, 2026, 27, 2035, 2047, 2049, 2050. All the payments we'll be making over all the remaining years, we discount it to present value and record it as planned liability today for that employee. And then we unwind the discount on it, that is interest expense. And we contribute the similar amount to a fund that gives us interest income. And if an employee leaves the firm in the middle, then from the fund which you created for 5,000 employees or 10,000 employees, we say benefit paid out to the employee from the fund. The liability got settled, the asset got reduced, plan asset got reduced. Now this calculation is not in the hand of an accountant. It's not an easy calculation to be done by an accountant, is the reason we need the help of an actuary who simply gives us the fair value of planned assets and fair value of planned liabilities. We are capable of accounting in the middle. We account for interest expense, interest income, we account for benefit paid out, we account for contribution paid to the fund. But still, when we reconcile, there is a difference. This difference is known as unrecognized actuarial gain and loss. The same unrecognized actuarial gain and loss in case of other long-term benefits is taken to P&L, but in case of defined benefit plans, it will be taken to OCI. Make sense? Termination benefits, depending on whatever is the liability at the end of the year, we'll have to charge it immediately. This is how we deal with defined benefit plans. The next standard is IAS 20 government grants. So we receive grants for two kinds of expenditures. One is capital expenditures and one is revenue expenditures. If we have bought an asset and we have received a grant for meeting the conditions, it is grants related to assets. If you have incurred an expenditure and we receive some support from the government or government aided organizations, that is grants related to income. So we have two choices to report this grant income, and it is only possible when we meet all the conditions related to the grant and grant becomes receivable. When it becomes receivable, we can report it, otherwise we cannot. Unconditional grants we can recognize immediately. If we receive any grant money, suppose we have bought a machine for 5 lakhs and we received a grant of 2 lakh. One choice is reduce the value of the machine, 5 lakh minus 2 lakh, and report the machine at an amount of 3 lakh in the books. This will result in reduced depreciation charge to P&L, but there will not be anything visible relating to how much grant we received. So the popular method is that you report the machine at 5 lakh, but on the credit side of the balance sheet, report deferred income. As you depreciate the asset, suppose this asset is depreciated over a period of 5 years. 5 lakh of machine depreciated over a period of 5 years will charge depreciation of 100,000 every year. And if you received a grant of 2 lakh, release this 2 lakh in the same systematic manner on which depreciation is charged. 200,000 divided by 5, 40,000 released to income statement in the form of government grant income. So net impact in the income statement is that 100,000 is charged in the form of depreciation, but 40,000 is grant income, reducing the net impact of expense to 60,000. So if we would have directly deducted the value of grant from the machine amount, 5 lakh minus 2 lakh, the 3 lakh of machine, the depreciation over a period of 5 years would have resulted in 60,000. Though the net impact remains the same, but the presentation is far better when we use deferred income approach instead of directly deducting the value of the grant from the value of the machine. It is preferable to use deferred income approach. This is how we deal with grants related to assets. And if there is any repayment of grant, depending on which method you used, if you created deferred income approach, definitely you need to reverse the balance in your deferred income approach. You need to charge additional depreciation. If you had directly deducted the value of the machine, if you had not deducted the value of the machine directly and you created a deferred income approach, then the depreciation is charged normally, fairly. But you need to reverse the income which you recognize, releasing it over a period of time. So depending on what you did initially, if you deducted the value of the asset, then you will have to charge excess depreciation. But if you did not deduct the value of an asset, you created a deferred income, then you need to repay 2 lakh, and whatever is the deferred income balance, that will be de-recognized. Whatever income you have reported into P&L, that will be reversed. And machine is normally depreciated, no problem with it. This is how we deal with grants related to assets. For grants related to income, you have a choice that either directly deduct the expense. Suppose you have incurred an expense of 1 lakh and received a grant of 60,000, you can directly report 40,000 as expense. The second method is you report an expense of 100,000, but if you have received a grant of 60,000, you show it as other income 60,000. That's how we present grants related to income. And if there is any repayment, reverse the charges, reverse whatever you have done. This is how we deal with government grants. The next standard is IAS 21, the effects of changes in foreign exchange rates. Now, the effects of changes in foreign exchange rates wants us to know what is the functional currency of the entity. We need to understand the foreign currency and the presentation currency. Functional currency is not an accounting policy choice. Presentation currency is an accounting policy choice. Foreign currency is any currency other than functional currency. So functional currency is the currency of the primary economic environment in which we are operating. The currency which influences the sales price of goods and services. The currency in which we are incurring expenditure. These are the primary indicators. If this doesn't help us to know the functional currency, then we look at the secondary indicators which say that the currency in which we retain or remit the funds to the parent, the currency in which we are financed. This helps us in assessment. This helps in an assessment. The assessment will lead us to so functional currency is an assessment and it is not an accounting policy choice, means we cannot decide the functional currency. So in spite of being in India, our functional currency can be dollars. The primary economic environment may be INR, but we may be deciding or denominating all our sales in dollars. We may be incurring expenditures in dollars. We may retaining and remitting the funds in dollars, financed in dollars. All this can happen. Once the functional currency is decided, any currency other than it is foreign currency. So when we compare the functional currency with the foreign currency, we'll have to convert all the foreign items into functional currency to be able to prepare financial statements. So functional currency is the currency in which we prepare financial statements. If you have dealt with any foreign item, that foreign item is supposed to be converted into functional currency. And in this conversion, it will result in some exchange gain or loss. So if you're dealing with monetary items, we'll have to convert those monetary items on the date of transaction. That is the first time we report them in the financial statements. And if the date of settlement is before the date of reporting date, we need to convert them on the date of settlement. But if the date of settlement is after the reporting date, then we need to convert it on 3 dates: date of transaction, date of reporting, and date of settlement. And every time we remeasure, the difference is supposed to be taken to P&L. But if we are dealing with non-monetary items, then we only convert them only on the date of transaction. Unless they're supposed to be fair valued or revalued at fair value, and that fair value or revalue is determined or denominated in a foreign currency. So if it is denominated in a foreign currency and if we take the difference to PNL, we'll take the difference of that foreign exchange also to PNL. If we take the difference to OCI, we'll have to take the entire exchange difference also to OCI. So non-monetary items will be converted only in special circumstances when they are revalued or fair valued. Else, they are converted only on the date of transaction. Monetary items, which are fixed number of determinable number of units. Suppose there is a liability of 5 lakh INR. The liability of 5 lakh INR remains 5 lakh on the date of transaction, date of reporting, date of settlement. The 5 lakh, the 500,000 number of units, the denominated currency is INR, it doesn't change. Fixed number of determinable number of units. Now, if our functional currency is dollars, definitely we'll have to convert it into dollars to be able to present it in our financial statements, which will result in some exchange gain or loss. That exchange gain or loss will be reported in P&L as foreign exchange gain or loss, which is realized gain or loss, to be reported in profit or loss account. Once we have prepared our financial statements in dollars, being in India, the regulatory authority may say that you have to present financial statements into INR. Now, when we are deciding to convert the entire set of financial statements into a presentation currency, this is not in control of the management. We cannot control gains or losses once we translate the financial statements. Whatever happens, happens. We report the foreign exchange gain or loss on translation of financial statements as part of other comprehensive income as part of OCI, which is unrealized gain or loss. We cannot do anything about it. We simply have to disclose it, no choice. And on disposal of a foreign operation, any foreign currency translation reserve can be reclassified to P&L on settlement. So sometimes share a story around it, the effects of change in foreign exchange rates. Suppose let's go to medieval period when the kings and emperors were fond of pigeons. And one of the king was really fond of grey pigeons. So he gave a command that all the pigeons in my state should be collected at one place. And he asked one of the ministers to give the census of the pigeons. It was told that there are 700 pigeons in the state, and he ordered to collect all 700 pigeons. The courtiers or the people of the state were successful in collecting 670 pigeons, which are black in color. But the command or demand was to collect 700 pigeons. They had no choice. They collected 30 more pigeons, but those 30 pigeons were white, purple, yellow, green, blue. They knew that king will get angry if they take all the pigeons of different colors also as part of the black pigeons. So they decided to paint all the different colored pigeons into gray. They converted the blue to gray, they converted the green to gray, they converted the yellow to gray, the red to gray, orange to gray. And this conversion led to an exchange gain or loss, some expense or some gain out of it. That expense or gain, foreign exchange gain or loss, on conversion of a foreign item. Foreign item was these yellow, purple, blue, orange, red pigeons were foreign items. They were converted into the functional currency of gray, because that was the expectation, that we need to prepare financial statements in gray. All the pigeons need to be gray. So any foreign item was converted to gray. And we were successful in preparing financial statements in our functional currency of gray. The emperor got to know that the state king has collected all the white pigeons, all the gray pigeons, and he was fond of white pigeons. he gave a command that we don't have white pigeons in our state. Why don't you convert all these gray pigeons into white and send them to me? Because I already have white pigeons collected because I was fond of them and I have been collecting them since years. I already have 1000 white pigeons. Along with your 700 pigeons, we'll have total 1700 pigeons to show it to the world that we are rich in the total number of pigeons. Now, this direction by the emperor resulted in translating all the gray pigeons into white. Now, is it in control of the management? No one can control it. Any exchange gain or loss on translation of entire set of financial statements, any difference is taken to OCI because now we are converting all the pigeons which were gray into one color white pigeon. This is known as translation of financial statements. So there are two steps to dealing with effects of change in foreign exchange rates. One is conversion of an item, the difference will be taken to P&L. One is translation of financial statements, the difference will be taken to OCI. This is how we deal with the effects of change in foreign exchange rates. Next is IAS 23 borrowing cost. Borrowing cost is a standard specifically for understanding whether we need to capitalize the interest cost or we can expense off the interest cost. The expectation is to capitalize interest cost. Normally, until now, we were expensing it off. But it was decided that if we are borrowing funds specifically for construction of an asset, which is a qualifying asset means which takes substantial period of time to get ready for its intended use or sale. If it is a qualifying asset and if we borrowed specifically, we should be eligible for capitalizing the cost of interest as part of the cost of the asset, which is known as borrowing cost. It was decided that if it is a qualifying asset, it is eligible for capitalizing the interest cost, and it's not a choice anymore. It is mandatorily required to be capitalized for acquisition, construction, or purchasing a qualifying asset. Any interest cost relating to it will be capitalized. So there are three stages of capitalization. One is commencement of capitalization, one is suspension of capitalization, one is cessation of capitalization. Capitalization commences when the borrowing costs are being incurred, when the activities necessary to prepare the asset have commenced, when the borrowed money is being spent, when all the three things have happened. The date on which all the three things have happened. The money is being spent, the money is bearing the interest cost, and the activities necessary to prepare the asset are happening. That day will commence capitalization. We suspend capitalization if there is a temporary delay in work which is not necessary for the development of that asset. But if that technical or administrative work is part of the process of that work, is necessary for its development, then will not suspend. And will cease capitalization the day substantially all the work is complete. Substantially means any pending work is not acting as a hurdle for the function for which we are creating that asset. Suppose we built a hotel and it is functional, only some decoration is pending on the outer side, which is not substantial. We can say the asset is ready for use. So C is capitalization. So we just discussed the foreign exchange. Sometimes what happens, some entities borrow funds from a foreign entity in foreign currency. The reason for borrowing was that the rate of interest was low in comparison to our home country. Suppose the rate of interest in the home country is 12% and rate of borrowing from a foreign currency was just 5%. But by the end of the year, The entity which borrowed in foreign currency suffered foreign exchange loss. Now, in the home country, they were eligible for capitalizing the interest cost, but the interest cost was low in terms of foreign currency borrowed money. Suppose the amount of interest eligible for capitalization in the home country is 100,000, but the amount of interest eligible for capitalization for the money borrowed in foreign currency is just 40,000. But they suffered an exchange loss of 80,000. Now they are seeking respite. They are saying that please allow us capitalization of exchange loss regarding it as an adjustment to interest cost. That if we would have borrowed in the home country, we were eligible for capitalizing 100,000. But since we borrowed in a foreign currency, we are eligible for capitalizing only 40,000. But our decision has also resulted in an exchange loss. We are suffering on both sides. We are suffering with an exchange loss in P&L. We are suffering by not being able to capitalize 60,000 of interest cost. Since we were eligible for capitalization of only 40,000 interest cost denominated in a foreign currency. So there was a relaxation given in IAS 23 borrowing cost that you can regard exchange loss as an adjustment to interest cost. So the difference in capitalization 40,000 and 100,000. We can regard 60,000 as an adjustment to interest cost. That is the effects of treating foreign exchange loss also as an amount which is eligible for capitalization equally to the amount which we have borrowed in the home currency. If they would have borrowed in the home currency, they would have been eligible for capitalization of 100,000. But since they borrowed in foreign currency, they were eligible for capitalization of only 40,000. So this relief is given to them to regard the exchange loss as an adjustment to interest cost. So this is how we deal with IAS 23 borrowing costs. We need to understand the definition of a qualifying asset, when the capitalization commences, when it suspends, when it ceases, and when it is regarded as an adjustment to interest cost. This is all for treatment of borrowing costs. Next standard is IAS 24 related party relationships. The standard on related party simply says that there is a possibility of biasness in case a related party relationship exists. It's not necessary that the financial statements are biased, but there is a possibility of them not reported in complete fairness simply because of a relationship. So to make aware the users of financial statements, the responsibility of the management to disclose all the related party relationships, the transactions with them, in spite of the fact that they have acted in total fairness. They cannot make a statement that they've acted in fairness unless they can substantiate it with proof. All the related party relationship, directly, indirectly, all the subsidiaries, associates, joint ventures. Two venturers in a joint venture may not necessarily be related parties because they are both acting in their own personal interest. Key management personnel, their family members, their children are all related parties. Key management personnel acting as directors in two companies may not necessarily be related. Creditors, trade unions, customers, stakeholders, they all act in their own best interest, so they are not necessarily related parties. Related party relationship also require the disclosure of the benefit being provided to the key management personnel, the salaries, the benefits, all are reported in the annual report. So in all, whosoever is related, who can influence the decisions of the entity, their names, their relationships should be disclosed. Like one of the key influential person is running a jewelry business. His wife purchased crores of jewelry from the store, and then it was reported that the customer turned bad. Unless the relationship is disclosed, we cannot say that it was a related party relationship which has a biasness that there was no money paid by the directors to the business and they have siphoned off acting as a customer, which is not fair at all. It becomes important to disclose the nature of transaction, the related parties, their names, the amount of transaction, how much of it has turned bad, which can give a clear indication to the users of financial statements that there is much more to the transaction than the real requirement of writing off bad debt. There could be a biasness in it. So all in all, anyone who is related need to be reported. Next standard is IAS 27 separate financial statements, which need to report all their investments at cost, at fair value. In IFRS, there is a choice for investment in associates and joint ventures also to be reported as equity method. Under Ind AS, there is no such relaxation. In IAS or IFRS, they do give relaxation for associates and joint ventures to also report their investments in equity accounting if they wish to. Otherwise, it is cost or fair value only. The next standard is IAS 28 investment in associates and joint ventures. Investment in associates and joint ventures is for equity accounting. Associates are someone like where we have significant influence. Significant influence means power to participate in the financial and operating policy decisions. And if we have the power to participate in the financial and operating policy decisions, then we need to present the investment in associate in the consolidated financial statements through equity method. This standard is specially for helping us to know the value to be reported in consolidated financial statements, not in individual financial statements. For individual financial statements, we need to look at IAS 27 separate financial statements. This IAS 28 is specifically linked to consolidated financial statements. That if you are presenting consolidated financial statements, how do we report it as part of consolidated results? So significant influence means power to participate in the financial and operating policy decisions, not control. Power to influence, which is reported in consolidated financial statements as cost of investment plus any share of profit from associate or JV. I'm including joint venture here because joint venture accounting is similar. Less any dividend received reduces the cost of investment. And if there is any intra-group transaction, the intra-group transaction is also eliminated to the extent of investment. Suppose if there is 25% investment, then intra-group transaction is also eliminated to the extent of 25% from the cost of investment. In the income statement, it is reported in a single line, replacing the investment income with share of profit from associate or joint venture. In the balance sheet, it is reported in a single line, investment in associate or joint venture. It is known as single line accounting, known as equity accounting. We are interested in the equity of that entity, that what we invested in the form of cost of investment, how our investment performed in the form of share of profit from associate or JV. Any dividend received from them is indirectly reducing the investment in that entity. And any intra-group transaction is also eliminated to the extent of share in associate or JV. This is how we report investment in associates and joint ventures. The next standard is IAS 32 Financial instruments presentation. Financial instruments presentation is mainly focusing on financial assets, financial liabilities, and recognition of equity. Financial assets are reported in the form of debt instruments and equity instruments, and equity and liabilities are reported on the basis of the obligation to pay. Even if there are convertible financial instruments or compound financial instruments, the one thin line which differentiates an equity and liability is if there is an obligation to pay, that will be reported as a liability. If there is no obligation to pay, it will be reported as equity. Even if we deal with compound financial instruments, it will have attributes of both an equity and liability. So we need to divide each component in terms of how much component we are obligated to pay, how much component we are not obligated to pay out of the total transaction. We'll clearly get to know how much we are obligated to pay and how much we are not obligated to pay. Whatever we are not obligated to pay will form part of our equity, which can be said as equity portion of a compound financial instrument. And whatever we are obligated to pay will be reported as a liability. All the arrangements in the capacity of compound financial instruments, mandatorily convertible shares, sometimes we'll have to repay the principal, sometimes we'll not have to repay the principal, sometimes we'll have to pay the interest, sometimes we'll not have to pay the interest. In all those cases, just look at it from the perspective of what are we obligated to pay over a period of time, what are we not obligated to pay. Whatever we are not obligated to pay will form part of our equity, whatever we are obligated to pay will form part of liability. And wherever there is a confusion, being conservative in approach will record it as a liability, then equity. Wherever there is clear bifurcation, we can clearly divide them into equity and liability. And the settlement can be in any form. We can settle our liabilities by paying cash. We can settle our liabilities by issuing equity shares. If we issue equity shares, will result in issue of equity shares from our share capital as well as settling of liabilities. We can satisfy these liabilities by making payments through our financial assets or other assets, exchange of assets. So whatever way we settle, every debit will have to equal credit somewhere. IAS 32 is all about presentation of financial instrument. Financial instrument is an asset which gives rise to an asset of one entity and liability of another entity. And if it doesn't meet this definition, it will not be considered as a financial instrument. The biggest example is cash. And if someone doesn't understand it, I always remind them of 8th November 2016 when the government decided to discontinue 500 rupee note. And if anyone was lucky to get back 500 rupee back, it was because it was mentioned on the note, I promise to pay the bearer a sum of 500 rupees signed by the governor. Whosoever was holding that promissory note or the tender or that financial instrument in the form of cash was holding an asset which is going to give them economic benefits worth equal to 500, and the corresponding liability was recorded by Reserve Bank of India. They had recorded a liability. I promised to pay the bearer a sum of 500 rupees. And they met the promise, exchanging the notes. For something to be recorded as a financial instrument, it has to have attributes of both financial asset and financial liability. Next end is IAS 33 earnings per share. Earnings per share requires us to present basic EPS and diluted EPS with equal prominence. For basic EPS, we need to calculate the earnings after making payments to all the stakeholders, even the preference shareholders. Whatever is left for ordinary shareholders, this is the numerator we use to divide it with the denominator weighted average number of shares. We take the weighted average number of shares because there is a relationship of issue of shares with the money coming in. When we issue shares, there's money which flows to the business. If money flows to the business, this will result in the growth of the company. If there is no corresponding flow of money to the business, growth is not possible. So if there is issue of shares during the year, then the weighted average number of shares will definitely be less than the number of shares outstanding at the end of the year if they were issued at different points in the year. So we need to calculate the weighted average number of shares to make it fair in approach, because the issue of shares also result in flow of money. If there is a bonus issue, there is no flow of money to the business. And to give a comparable picture of the previous year, we assume as if the bonus issue has taken place from the beginning of the previous year, which means we assume it has taken place at the beginning of the previous year. Means if 100,000 shares were in issue and if 20,000 was bonus issue, we'll assume it has taken place at the beginning of the previous year. Means last year EPS will recalculate with 120,000 shares, and this year's EPS will calculate with 120,000 shares, believing that it has taken place from the beginning of the previous year. In case of rights issue, we come across a situation wherein after rights issue the number of shares increase, but before rights issue there is a period which has a bonus element, because the rights issue brings in money but doesn't bring in exactly equal to the fair value of the share in the market. So there is a bonus element in the fraction of the period before the rights issue. That bonus element is anyway assumed to have taken place at the beginning of the previous year. We make the adjustment for the previous year EPS with this bonus element, and we make the adjustment for the current year EPS, calculating the weighted average number of shares for the bonus element for the period before the rights issue. So the number of shares to be used in EPS calculation for rights issue is divided into two parts: period before rights issue and period after rights issue. Period after rights issue is the number of shares after rights issue multiplied with the fraction of the year after rights issue. But period before the rights issue is the number of shares before rights issue, fraction of the year before rights issue is multiplied with the fair value of the share and divided with the theoretical X rights price. And what is the average price for the holder of those shares? Why did we multiply it with the fair value and divided it with the theoretical X rights price? Simply meant that if someone is owning 100,000 shares, and if fair value of share in the market is 5 per share, then they are having 5 lakh worth of value in the market. And these people have the right to buy shares by paying just 4 rupee per share. Now the holder of these shares, if they can pay just 4 rupee and they can buy one share for every 5 shares held, the total number of shares will be 120,000. But they have bought it by paying just 4 rupee instead of 5. That means the total investment in terms of shares is someone holding 1 lakh shares is holding value worth 5 lakh, and to buy 20,000 shares they'll have to pay just 80,000. Total 120,000 shares will cost them 5 lakh 80,000. So the average price for someone holding these shares will be 4.83. If the average price is 4.83, how many shares they could have purchased? If someone is owning 100,000 shares and if the market price is 5 for them, and if they can get it for only 4.83, what is the weighted average number of shares for the period before the rights issue? If 100,000 shares are in issue and if the market price is 5 and if the average price is 4.83, the number of shares before the rights issue should have been 103519. The bonus element is considered. The same calculation is being done for the previous year for the bonus element. That's why in case of rights issue we divided the denominator calculation in two parts: period before rights issue, period after rights issue. Period after rights issue is very clear. The total number of shares are 120,000. For the fraction of the period is say 3 months. After 9 months, this bonus issue has taken place. Rights issue has taken place. The period before rights issue is 9 months. 1 lakh into 9 by 12 into 5 is the market price. 4.83 is the theoretical exercise price. We'll get the number of shares to be used in EPS calculation for the period before the rights issue plus for the period after the rights issue. And we get the EPS in case of a rights issue. In case of a bonus issue, we assume it has taken place from the beginning of the previous year. Quite straightforward. We also need to present diluted EPS with equal prominence. The diluted EPS is a calculation on the assumption that what if the potential ordinary shares get converted into ordinary shares? If they get converted into ordinary shares, what will be the impact of it? So we try to calculate the incremental earnings because of conversion, incremental dilution of shares. We compare it with the basic EPS. And if they are dilutive in nature, we calculate diluted EPS. If they are anti-dilutive in circumstance, we do not include them as part of diluted EPS calculation. If there are share options, we see what would have been the number of shares issued at market price, how many shares are issued because of the share options. The difference is the bonus element which we include as part of the denominator only, and we calculate the diluted EPS for share options. That's how we deal with EPS. The next standard is IAS 34 interim reporting. Now, interim reporting is applicable only if you are presenting interim reports. It says that you have a choice. You can present full set of financial statements or condensed set of financial statements. If you are presenting full set of financial statements, please refer IAS 1 presentation of financial statements. If you are using condensed set of financial statements, you can refer to IAS 34, which is encouraged. It's not mandatory. Only if you are using or preparing interim reports in your country or jurisdiction or required by accountancy body, then we need to refer to IAS 34 interim reporting, which along with condensed set of financial statements, which wants us to use the same heading subtotals which we used in the last reporting period, and selected explanatory notes. No detailed explanation as was done in the most recent annual financial statement published. As far as balance sheet is concerned, we report the interim period end balance sheet, and in comparison, we publish the most recent annual financial statement published. Suppose we are into the second interim period of 30th September. In comparison, we'll publish the balance sheet of 31st March 2023 if we are presenting the interim balance sheet of 30th September 2023. For the income statement, we'll present the current interim period and cumulative year to date period. Current interim period began on 1st July, ends on 30th September. Comparative will be of the last year 2022, current year 2023. Cumulative year to date will begin from 1st April 2023 to 30th September 23. Comparative will begin from 1st April 2022 to 30th September 2022. This is the requirement of income statement. Current interim period plus cumulative year to date period. In case of statement of cash flows and changes in equity, it will only be cumulative year to date. That is beginning from 1st April 23 to ending on 30th September 23, current year, and comparative beginning on 1st April 22 to 30th September 22. No concept of current interim period for cash flows and changes in equity. This is the requirement of interim reporting. Next standard is IAS 36 impairment of assets. The impairment of assets is applicable for all the accounting standards which record their assets at cost model. It is not needed for IAS 2 inventories because IAS 2 inventories have an automatic impairment system. They always record inventories at lower of cost NRV, so inventories don't need it. It's not needed for assets which are measured at fair value model like IAS 40 investment property. But impairment is applicable on IAS 16 PPE. IAS 16 PPE uses revaluation model. But once an impairment loss is known, then the revaluation model overrides. We'll follow the principles of revaluation model for dealing with the fall in value of an asset. Impairment means loss. Impairment means fall in value of an asset. It acts as a check on all the assets which are measured at cost model. That if carrying amount of an asset is higher than the recoverable amount, then it's not fair to be presented in the financial statements at that value. We need to keep a check on it. The recoverable amount is higher of value in use and favorably less cost to sell. There are only two ways of recovering the value of an asset. Either we sell it or either we use it. If we sell an asset, we'll get favorably less cost to sell. If we use an asset, we get the present value of net inflows. Whatever gives us more value, we'll do that. Either we sell it, either we use it. We get higher value through recoverable amount. When we compare this recoverable amount with the carrying amount, if carrying amount is higher than recoverable amount, then it is not fair to present this figure in the financial statements. We charge the impairment loss to P&L and record the asset at recoverable amount. But if carrying amount is lower than the recoverable amount, then we do nothing, being conservative in approach. It's like declaration in your society that I'm going to crack UPSC. No one believes it. But the moment you say I'm going to fail, everyone believes it like they already knew it. The losses are recognized immediately. Profits, we are conservative in approach. The same concept is used in accounting as well. Profits, we wait and watch. Losses, immediately recognized. In future, reversal of impairment is also possible. Only goodwill is an asset which is not reversed. If there is an impairment of goodwill, it is not reversed. All other assets can reverse to the extent of cost. And if there is an asset at revaluation model, the principles of revaluation model will apply. What to do when there is an increase in the value of an asset or decrease in the value of an asset. The principles of revaluation model will apply. So when I say reversal is possible to the extent of cost, which means that if we try to increase the value of an asset beyond cost, we are making a declaration of changing the model from cost model to revaluation model. If you don't intend to change the model from cost model to revaluation model, don't value your asset beyond cost. We need to compare what would have been its value had it not been impaired, and what is the value now since we impaired it. Any reversal should not result in recording an asset beyond its cost. We need to be careful. This is how we deal with impairment of assets. The next standard is IAS 37, provisions, contingent liabilities, and contingent assets. This was used for creative accounting. Create a provision when not needed, or do not create a provision when needed. It was decided that if it meets three conditions, there is a present obligation as a result of past event from which future economic benefits are expected to flow out to the entity, and it can be reliably estimated. So even if it is probable, there is a present obligation, it is probable and it can be estimated, we need to create a provision. It is different from liability because liability is a present obligation of a certain amount to be paid at a certain time. Liability is certain. Provision is either amount or timing is uncertain. It's probable and the amount can be reliably estimated. If it meets this condition, we need to create a provision. We have no choice. The third category is contingent liability. Neither amount nor timing is certain. So since we cannot assign any value to the contingent liability, we simply disclose it as part of notes to accounts. We discuss about the financial impact of it. Provision has a link with IAS 16 property, plant and equipment for creating the provision for dismantling restoration. It has a link with warranty costs of revenue, that while recording revenue, if the seller of goods have provided any warranty provision may need to be created because of the promise made. So we need to estimate the amount of warranty and need to include it as part of provisions. Now the techniques used for estimating provision is most likely amount or expected value method. Most likely amount is used when the outcomes are two. One is certain to happen. Whatever is most likely to happen, we create a provision on the basis of that. Expected value method we use when the probabilities are large. If there are many probabilities, we use expected value method and take the average value to be recorded in the form of provision. And finally, we settle the provision on the date we are supposed to meet that liability. Any increase or decrease is taken to P&L. Provision means we do not know the amount in actual to be spent. is the reason we estimate it reliably. What if we do not create a provision? We'll not be able to record anything. And suddenly we'll end up hitting the balance sheet with a huge chunk of money, and the users of financial statements will simply be in a shock that you didn't tell us. Why did you spend 50 lakh dollars? But if we inform them that we are expecting to spend 50 lakh dollars on the basis of a promise made in the past, they will be prepared. But if the actual payment is 49 lakh 50,000, I think they'll not be in a shock because they were prepared. It will be around 50 lakhs. We estimated it. If the actual payment is 54 lakhs, then also they'll not be bothered. But we do not disclose anything and suddenly give them a shock. 50 lakh was spent. This is not acceptable. If there is a present obligation, probable economic benefits will flow out of the entity, and if you can reliably estimate it, please do not ignore it. Record it as part of the balance sheet in the form of a provision. You cannot ignore it and give a shock to the users of financial statements. It's fairer to present a probability than giving a shock, waiting for actual liability. That's the concept of provision. It's a journey. Customer has filed a case against the entity, demanding 1 crore in compensation. The lawyers are very optimistic. They say, no, we don't have to pay anything. You just pay our fees, we'll take care. And we disclose a contingent liability that we have to pay nothing. Our lawyers are very optimistic. As the case progresses, the lawyer is making excuses. You didn't give me this file, you didn't inform me about this, you have hidden this information, you should have informed me about this. Now we are not in a situation to save it at point blank. We'll have to pay something. Though they are demanding 1 crore, we'll try to settle it in 40 lakhs. We ask again, are you sure we'll have to pay 40 lakhs? The lawyers say yes, minimum 40 lakhs we'll have to pay. Suddenly it's moving on from contingent liability to 40 lakhs of most likely amount, a provision. And they demand their fees. Please pay our fees. We'll try to reduce it from 40 lakhs. But the chances are we'll have to pay 40 lakhs. Then there is a judgment after the reporting date. We created a provision of 40 lakhs, but after the reporting date, there's a judgment declaration which says we'll have to pay 66 lakhs. We reached the lawyers. What has happened? They said there was something which was hidden by you. We tried our best to reduce it to the minimum, but we could not. And the judge has given an unfavorable statement, and we have to pay now 66 lakhs. We are in a confusion that we created a provision of 40 lakhs on the reporting date, but after 15 days, the court declared judgment. Shall I include it as part of the financial statement? Shall I ignore it? An IAS 10 events after the reporting date says that it is an adjusting event because it gives evidence of conditions existing on the reporting date. It's your lawyers who did not give you the clear picture. Condition of payment of 66 lakh existed. It's just that your lawyers were very optimistic. You created a provision of 40 lakhs, but the reality was 66 lakhs. So include 66 lakhs of liability in the balance sheet and publish it. Record a loss into P&L. And this also needs to be highlighted if it is in the form of a penalty. It can cast a doubt on the going concern status of the entity as well, which is also a cause of concern. This is how we deal with IAS 37 provisions, contingent liabilities, and contingent assets. The next standard is IAS 38 intangible assets. It's exactly similar to IAS 16 property, plant, and equipment tangible assets. The only difference with tangible and intangible assets is intangible assets also have intangible assets with indefinite life, where we do not charge any amortization. The word depreciation is replaced with amortization because we cannot see the physical wear and tear happening with the asset. There is an amortization in value, though they are complementary or used interchangeably. From the accounting perspective, we use amortization for intangible assets. We come across with assets with finite life and indefinite life. We do not use the term infinite, because indefinite means it is not defined today, but it can be defined someday. Finite lives like license are amortized over a period of the term of license. Indefinite life like motion pictures, movies, they continue to give the benefit to the producer for a longer period of time. Like the producers of Ramayana are benefiting by selling the rights to many TV channels which come up. They pay to the producers again and again. And they're benefiting it for an indefinite period, and they will get benefited for a long period of time. It's not defined. So all the costs which they incurred to produce this intangible asset, they capitalized it and is not subject to amortization. So it is said that internally generated intangible assets are not capitalized or not recorded. We cannot assign any value to them. Internally generated goodwill, masthead, copyright has no value. Only purchased goodwill, purchased copyright, purchased masthead, trademark has a value. So the question is, can we capitalize anything which is internally generated? So there is a concept of research and development expenditure which says that anything which is in trial stage, formulation, evaluation, not reaching a conclusion, any expenditure done till that date is expensed off. But if someday we reach a stage wherein whatever we are developing is technically feasible, commercially viable, the entity has intention to complete, resources to complete, it can be liably measured, have technical know-how, finances, ability, they have the use of it, or they'll be able to sell it in the market, there is a ready market for it, and all these conditions are met. Any expenditure incurred from that point, when it reaches the cutoff point of being eligible for capitalization, any expenditure incurred after that is eligible for capitalization as and included as part of development expenditure. Now this is not amortized because this is not yet available for use. So we keep on adding the cost and show it as part of our intangible asset not yet available for use, subject to impairment but not amortization. We come across three assets in intangible assets category: intangible assets with indefinite life, intangible assets not yet available for use, and goodwill, which are tested for impairment annually regardless of indicators of impairment. Annually doesn't necessarily means reporting date. Annually means once in a year. We need to test them for impairment. Any loss is taken to P&L. Any impairment loss on goodwill is not reversed. On all other assets, it can reverse to the extent of cost. These intangible assets, which is in the category of not yet available for use, may someday reach a stage wherein we can decide their finite life or indefinite life. If we can decide their finite life, they will be subject to amortization. If they are still in the category of indefinite life, we will not charge any amortization on them. Indefinite should not be confused with infinite. Only land can be considered as infinite unless there is an ultimatum from Mars that leave planet Earth. Only that day I think we'll have to assign life to our time on Earth. Until then, we can continue to enjoy the benefits of land being a non-depreciable asset. So this is how we deal with IAS 38 intangible assets. Among the impairment assets, we discussed about impairment of an individual asset. But when we calculate goodwill, we can assign any goodwill to CGU as well. CGU is the smallest identifiable group of assets capable of generating cash flows together. They are individually capable of not generating cash flows. Only together they can generate, like a restaurant. There are baking machines, there are chairs, tables, there are other equipments supporting the generation of revenue. So we have two situations: CGU with goodwill, CGU without goodwill. If there is any doubt on recoverability of the CGU, we test them for impairment. And if there is an impairment loss, we first charge it to the asset which is specifically impaired. Second, to goodwill if that is included as part of that CGU. Third, on pro rata basis. If there is a CGU without goodwill, then first to any asset specifically impaired, remaining impairment loss on pro rata basis to all other assets. We charge it to the assets within that CGU. So this is the hierarchy to be followed. First, to any asset specifically impaired. Second, goodwill if it exists. Third, impairment loss on remaining assets on pro rata basis. This is how we allocate the impairment loss in case of a CGU. So goodwill can be assigned to all the CGUs which benefit from the synergies of business combination. This is how we deal with intangible assets. The next standard is IAS 40 investment property. IAS 40 is the standard for dealing with investment properties, means land and building held for capital appreciation or for renting it out to others, especially for land and building. So we have two models, cost model or fair value model. In Ind AS, there is no concept of fair value model, only cost model. In IFRS, we have two models, cost model and fair value model. Cost model, we charge depreciation in the same manner as we did for IAS 16 property, plant and equipment. Historical cost less, accumulated depreciation less, any impairment. Land is not subject to depreciation, building is subject to depreciation. If it is measured at fair value model, it is not subject to depreciation. We do not charge any depreciation. It is remeasured on each reporting date. The difference is taken to P&L. If you are measuring investment property at cost model, we disclose the fair value of the property in the notes to accounts. Same is the requirement with Ind AS 40. We measure the investment properties at cost model, but we disclose the fair value of those investment properties in the notes to accounts. So what is exactly the difference between fair value model and revaluation model? The difference between fair value and revaluation model is revaluation model is done with sufficient regularity, not necessarily to be done at the end of each year. Revaluation model is the concept of property, plant and equipment and intangible assets. If you revalue an asset on revalued amount, it is subject to depreciation on the remaining useful life. But if you measure it at fair value model, it is not subject to depreciation. As I said, revaluation is done with sufficient regularity. Fair value model requires remeasurement on each reporting date, and the difference is taken to P&L. In case of revaluation model, any movement is dependent on upward or downward movement of revaluation, and revaluation model takes care of the movements whether to be taken to OCI or whether to be taken to P&L. But fair value model, all the differences are taken to P&L. Fair value model is specifically applicable only to land and building held for capital appreciation or for renting it out to others. And other big thing is that if we sell any asset belonging to PPE category, it can disrupt our business. But if we sell any land and building belonging to investment property, it will not disrupt our business because this was an investment property held for capital appreciation or for renting it out to others. We had kept it for rainy days. And if we sell it, it will not impact our smooth running of the business. This is how we deal with IAS 40 investment property. And if there are transfers between IAS 16 to 40, that is also possible. Then on the date of transfer, we need to measure it on existing measurement basis. If it is being transferred from IAS 16 PP, measure it on existing measurement basis, and then transfer it to 40 depending on what is the model being used in 40. So this is how we deal with investment properties. The next standard is IAS 41 agriculture, last standard in the list of IAS. It's a standard specifically for biological assets, living animals and plants. The classic example is of a mango tree. Mango tree is belonging to property, plant and equipment because it is a bearer plant which bears fruits. If it is a perishable annual crop, it will be in the category of IAS 41 agriculture. So there are two situations. Agriculture produced at the point of harvest is belonging to the standard on agriculture. Agriculture produced at the point of harvest, like wheat, grains, immediately before harvest. If we value them at fair value less cost to sell. The moment they are harvested, they are converted into inventories, IS2 inventories. The wheat grains belong to IS2 inventories, but wheat grains derive their value from IS 41 agriculture at fair value less cost to sell. Animals in the zoo or the fish in the pond are not managed and cannot be said as an agricultural activity. Actual agricultural activity is managed. Management of production, recreation, growth, degeneration of an animal or a plant is agricultural activity. And if someone is engaged into it, they can get benefited out of it. They need to report the difference in P&L. So all the animals which are biological assets are belonging to IS 41 agriculture. We look for the change in their growth, weight, size, quality, and report it into P&L. And we also disclose in the notes to accounts the change in price and change in quality or quantity. We bifurcate in the form of disclosure why there is a change in fair value of a biological asset and how much of it is attributable to change in price, how much of it is attributable to change in quality or quantity. If it is a bearer plant like mango tree, grape, wine, palm trees, these bearer plants belong to IAS 16 PP. They can be measured at cost model or revolution model. But the agricultural produce on these bearer plants belong to IAS 41 agriculture. Like the mango fruits on the mango tree belong to IAS 41. Mango tree is belonging to IAS 16. The mango fruits onto the tree are agriculture produced at the point of harvest, belonging to IAS 41 agriculture. The moment we pluck the mangoes, they get converted to IAS 2 inventories. But the fair value derived at the point of harvest becomes the cost of inventories for IAS 2. That's how there is transfer of value from IAS 41 agriculture at the point of harvest to IAS 2 inventories in the form of plucked mangoes ready for sale in the market. One mango tree holds three accounting standards: IAS 16, IAS 41 agriculture, and IAS 2 inventories. And they are measured simply at fair value less cost to sell. The concept of government grant is not applicable to the standard on agriculture because agriculture standard is measured at fair value less cost to sell. There is no chance we can apply deferred income approach. So any government grant received is also directly reported in P&L. Any unconditional grant is also directly reported in P&L. But yes, government grant can be applicable to the mango tree, which is measured under IAS 16 property, plant and equipment if it is measured at cost model or revolution model, whatever the method. It can be applicable under IAS 16 PP, but government grants in their existing manner and format are not applicable to biological assets in IAS 41 agriculture. This is all for the concept of agriculture, and I've been successful in completing the series from IAS 1 to IAS 41 till now. Hope you've understood the summary of all the IAS standards and will be able to recall in a summarized format what is actually being expected of a particular standard. All this information or knowledge can also be used in any of your interview questions, in your day-to-day life, to crack any examinations. It can help in many ways. They are truly insights of IFRS.